Financial news now. For the first time since last December, the Federal Reserve cuts its benchmark interest rate today. They voted 11-1, the Fed did, for that quarter-point rate cut. So the new rate is now 4 to 4.25%. This also marks the first rate cut of President Donald Trump's second term. And that's an action the president has been pressing for now for months. So we hear a lot about these rate cuts when they happen. And we wanted to get a little technical here. What do they really mean? So I'm joined by Dean Wegner here, who's a mortgage loan originator with Sunflower Bank. Dean, you're great. You're a wealth of knowledge. Thanks for being here. I appreciate it.
Thank you, Troy.
Let's start at the very base level. What exactly, when the Fed cuts the rate, what rate are they cutting?
So this is the Fed funds rate. This is the overnight rate that banks borrow from the Fed, which is a bank for banks, and also from each other. So it's kind of like the tide going in or the tide going out. You know, it affects everybody essentially.
So why does a bank have to borrow money from the Fed?
Well, they have reserve requirements depending on how much they have lent and how much they have on hand. And if they're short, they have to meet that overnight. So they have to make sure that that allocation is in line with the FDIC requirements, essentially.
So some bank may actually borrow this every single day and pay it off every single day, or borrow it for a week or later. So the cost to borrow that money has now gone down for that bank. What's the first thing that we see happen as consumers because of that?
Well, consumers, the first adverse thing, because when we think about rates going down, it's a positive, right? The housing market's going nuts. Everyone's celebrating. They're popping champagne probably right now in real estate offices, nationwide.
Because you're thinking about interest that we pay, but there's other interest, the interest you get.
So the interest you get. So the first thing you're going to see is in your money market account, for example. We've been really enjoying the last couple of years of like a 4, 4.5, sometimes 4.95 in your money market with a low balance. You're going to see that start to trickle. In fact, you probably saw that in the last 2 to 3 weeks with anticipation of this cut, with those coming down. The next is going to be your checkings and your savings, and those three things are going to be affected. And we can talk about CDs too.
Yeah, so CDs, especially for, I guess, older people, maybe even younger people, but it's a safe place to put your money that generally pays you more interest than a regular savings account. So what's going to happen now with CDs because of this cut?
Well, that's exactly it. So it's a very safe haven place for older people. You're not going to lose it. It's insured, but it's going to auto-renew. So if you have a CD, you've been enjoying these really nice rates, and when that auto-renews, you're going to notice it's going to renew at a much lower rate than what you had before. And because they're anticipating 2 more cuts, it's going to go even lower as the year continues.
Right. So I remember it wasn't that long ago that you could get a 1-year CD at 5%, but now it's going to be down much lower. You're just not, if you have $10,000 you're putting in a CD, you're just not going to make as much money off that CD.
That's correct. And if you're with a credit union or a bank and it does auto-renew, you can walk into them, talk about the auto-renew, and tell them to pause it, put it in your checking account, and then you can decide what you want to do with that money.
Okay, so now let's talk about paying interest, because there are some different credit companies that go directly off of this rate. And you said one of those is, let's say you borrowed $10,000 to redo your kitchen and took out a home equity loan.
So yeah, the biggest impact, dollar for dollar, you can do the math tonight, 1/4% lower on your home equity line of credit. So whatever if it's prime plus 1/4, prime plus 1/2, subtract that, get your statement, look at the rate, subtract 1/4, and you should see that show up in your November 1st statement.
So that'll happen right there.
Yeah.
And some credit cards, you say, are also tied to this.
Credit cards are tied to it, but it's not exactly where you can do the math yourself. It will eventually come down. It could trickle a bit lower, but it's not like dollar for dollar like an equity line.
Okay, so now let's talk about your end of this business, which is mortgage rates.
Yeah.
Now, mortgage rates aren't directly tied to the Fed, but there's like a trickle-down effect, and there's different things that impact it. So how are mortgage rates going to be impacted by this, you think?
So, well, what happened in the press conference after the Fed meeting, because that's just as important as the Fed cut, and a reporter asked Jerome Powell, is a quarter really going to do anything? And he says, not really. However, it's the anticipation of the future rate cuts that's going to send the market in the right direction. And essentially what he alluded to is rates are going to continue to come down. That's where mortgage companies in the secondary market's really going to price in lower mortgage rates going forward. So we should start seeing that, even tomorrow we could start seeing lower rates, because we do know we're probably going to get 2 more cuts this year. Right. And the Fed meets every 6 weeks.
And if you've got a full point, if it comes down, I mean, what's the difference? Median house right now, I think, is around $400,000, right? Or maybe a little over.
Yeah.
How much is your payment lowered if you have like 1 percentage point lower on your interest rate?
On $400,000, Troy, that's going to come out to about $260 a month for better, which is huge.
Right. Dean Wegner, thank you for being here.
Bet.
Appreciate it. Good information. Tram.
Tomorrow on 12.